Hello again, everyone. It's 10 o'clock in the morning, Chicago time, on Thursday, September 22nd, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially through the end of the year. Let's begin. Number 1. Market internals. The Asbury 6 remains negative. So those of you that are familiar with me or Asbury Research through StockCharts or through other places I'm seeing around the internet have probably heard me mention the Asbury 6. The Asbury 6 is an indicator that I built about 5 years ago to try to get a better and more accurate handle on what the daily health is in the U.S. stock market, because following the S&P 500 day to day doesn't work like it used to. A lot of day-to-day volatility, which we've all experienced. The market, we wake up in the morning and the market's up 50. It finishes the day down 50, and then the following day it's up 100. There's a lot of churn in these markets that I believe comes from more and more computerized trading, which often pushes our buttons, forces us to get out of long positions that we don't want to, and then it kind of forces us to get back into them when the market jerks higher the next day. So what we did is we took all of my favorite tactical market indicators from my entire career, the ones that I thought had the most value, and we started to test them in sets of 4, sets of 10, sets of 8, looking for indicators that would kind of support each other. When 1 or 2 indicators are giving you a bad signal, the other 4 would pick you up. Kind of like a sports team. When one guy makes an error, the other guy comes around behind him. And we ended up with 6, only one of which, the one on the top, the rate of change in the S&P 500, has to do directly with what the S&P 500 is doing. We did that purposefully. We wanted to be aware of what the S&P 500 is doing. Obviously, that's how we get paid as investors, but we wanted to look at other secondary indicators that couldn't be directly affected, immediately affected by this herky-jerky nature of the markets right now. So we came up with relative performance between stocks and bonds, investor asset flows, corporate bond spreads, trading volume, and market breadth. You can see right now they're all red. Red means negative. 4 or more in one direction, either red for negative or green for positive, indicates a signal. So the last time I was with you was on August the 24th, almost exactly a month ago today, and we pointed out that the Asbury 6 had gone negative on August 23rd. You can see that there was a few kind of herky-jerky motions, which we call blinking, in the Asbury 6, but effectively August 23rd through now, we're still negative, and the S&P, I believe, has dropped by about 9% since then. So when the Asbury 6 turns back to green, just to spend another second on that, that will tell us that the internal conditions of the market have improved to the point where we can now look to add some risk back to the market. But right now, it's negative. Our other model, which we're not going to talk about today, the CPM, or the correction protection model, that has been negative for most of this year. And through just about 2 or 3 days ago, the S&P was down 18 for the year, and CPM was down about 8. So it's protected us from significant losses during this year's downtrend. That's what the Asbury 6 is meant to do as well. So let's move forward to the S&P 500 and look where the key levels are, so we know where to look for possible bottoms in the market. Right now, that next level is 2.4% underneath the market. It's at 37.23 to 36.94, and it represents the January and March benchmark lows from back in 2021. You can see we exceeded that just for a little bit, just for a couple of days in the middle of June of this year, and that was the launching pad for the rally that took us back to the August highs. So let's call this 3,700, basically right in the middle of these two levels from these old lows. That's our, what I would call, initial support. It's the one that's right underneath us. The most important one is the September 2020 high of 35.88. We got close to it on June 17th. It's still a really big level. That's a level, if we get there, I'm going to really be paying a lot of attention, kind of keeping my ear to the track, so to speak, to look for other signs of market internals getting better, to look for a possible bottom. In terms of where the trend is, right now, the minor trend is down below 40.41 to 41.15. That represents the 50-day moving average here in blue, and also the February 24th benchmark low, and that's at 41.15. So we have a lot of room where we could rally in the S&P 500 and still not even come close to threatening the minor downtrend. Number 3, investor asset flows are still negative in QQQ. Again, the last time I was with you, excuse me, on the 24th of August, this was one of the charts in our deck. So here's August 24th, when I was with you last. On August the 22nd, we had pointed out that the total net assets invested in the Invesco QQQ ETF had declined below their 21-day moving average to indicate an emerging trend of monthly contraction. Monthly contraction means assets are leaving that particular asset, and NDX, which is what the QQQ tracks, NDX is NASDAQ 100, then indicates that there are assets leaving there, and the monthly trend is towards assets leaving, assets out. And look what's happened since then. We've gone down 11%. Qs have dropped, the NDX actually has dropped by 11% since that signal. The prior signal, look at this, from July 6th to August 21st, that gave us all of this upside in the NDX. So this is another thing that we watch every day. When these assets start to turn positive again, in other words, they trade back above their 21-day moving average, which is Asbury Research's tactical time period, that's going to be an indication of an opportunity for us. It's not here yet, but once those assets start to turn again, that's going to suggest to us that we may have some new leadership coming out of technology, and there may be a chance to take some of that money that we have taken out of the market this year to avoid a lot of the decline, put that money back to work at better and lower prices. Number 4, seasonality, weakness through early October. This is the weekly seasonal pattern for the third quarter in the S&P 500 based on data since 1957. You can see that the first, second, and fourth weeks of September are the weakest weeks, 3 of the 4 weakest weeks, I should say, of the entire third quarter. What we don't show here is that October is also weak. That first third of the fourth quarter, which is October, is where it's getting stronger. The market is getting stronger seasonally, but there's still a lot of weakness. So we're really not out of the woods seasonally until we get through October. That just tells me what we're seeing on the chart. The trend is down. Assets are leaving the QQQ. The Asbury 6 is negative. Seasonality, there's a wind, so to speak, a bias from seasonality that's going to continue to put pressure down on the market. So another negative bias for the market, at least until we get through next month. Finally, number 5, investor sentiment. Market close to a bottom. This is the investors' intelligence data. One of the best data series that I know of to look at investor sentiment. They have a number of ways to look at it. You can check them out on their website. We're actually an input for the investors' intelligence data, we being Asbury Research. So we're always looking at their data to try to look for extremes, and we've got one right now. This is the percentage of bears according to this data, which covers stock market newsletter writers. There's really, I don't know if there's anybody that actually writes a newsletter anymore and puts them in the mail, but they're people like Asbury Research, people who write research, typically independents that put research pieces out for their clients. We have clients that are both individual investors and also professional investors, money managers. So the interview, I don't know how many, and they try to come up with a bias of where everyone is on the bullish or bearish scale. Right now, you can see the percentage of bears in the market. There was a peak on June the 17th that turned out to be the bottom. in the S&P 500. There was another one in March of 2020, another one in December of 2018, another one February 2016, October 2011, August of 2010. They're all bottoms, and we're right back there now. We had to move off of those extremes into mid-August. That's this little low that we see here, but we're right there. What does that tell me? It doesn't tell me that it's a buy signal today. We need the Asbury 6 to turn. We need our CPM, the correction protection model, to turn risk on. We need to see a lot of short-term things happen to tell us that it's time to pull the trigger on getting back in the market. This tells us we're in the neighborhood. This tells us we're probably within a few weeks or so of an important bottom that, in hindsight, is probably going to have the importance of these other bottoms that you have in the chart. So if you're throwing your hands up in the air and saying this thing's going to go lower forever because the Fed is raising rates and we're going into a recession and we're going into an election time, this chart says something totally different. It tells you to pay attention, watch your tactical indicators, and when they turn back to positive, you may have an opportunity to buy into another low that has the significance or similar significance to these others. So we're on our toes right now. We're paying attention to this, and we're looking for the tactical signals to tell us that it's time to get back into the market. So there it is. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. If you'd like to see more videos like this one, visit the Asbury Research channel on YouTube and subscribe. Thanks for watching, and I will see you at the next one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.